All right. Hello, everybody. Welcome to the July 9th Trade Findings and Adjustments with Hurley Investments. I'm Keith Bybee. Thanks for joining me. Those of you that are here already, you should be hearing me good. And let's get started. So, wanted to go over a couple things that Kevin had done from last night and let you know about, and maybe go over a couple of the older positions and look at a new one that I would look to recommend. So first thing, he talked about a Apple bull call that he got filled today. Let's just look at the history to make sure. Have to clear that first. E-Trade is being weird. Let's see. Not seeing it. All right, never mind. No Apple. So maybe it was in another account. I don't know. It's throwing me for a curve there. He said he got filled on the Apple bull call he talked about yesterday for $1.75 or so. I think it's what he said. So I guess I will let him go over that Thursday because I'm not seeing it anywhere. Sorry about that. All right. In that case, let's go over AOBC. He did dollar cost average and did another 3 contracts of a $10, $12.50 bull call, lowered the cost basis. Originally was 75 cents and lowered it about to 68 cents or so as I calculated it. Let me just go to the history again and look for sure. AOBC, and if you remember, that was one I had put on and said good luck to Kevin. Hope it works out. Sorry if it loses money in your account. And it looks like he's going with it. I still like it. And yeah, here's our numbers, but just added 3 more contracts. So if you're following that one, he got filled, and it doesn't tell me the actual numbers he got filled, but let me see, about 58 cents. So if you can get that price on the spread or better, I think that is still worth in his case, doubling down on. I don't know what your case is, if any of you guys have done this one, but, and I guess on that note, I would recommend going for it if you're looking to start something. Just to take a look at, erase that. Maybe I need to go back to yesterday's. Market commentary to see what he was talking about. So here's AOBC. So on Thursday the 20th, I think, this big black one, you see right here, was where I suggested, hey, let's do a cheap little bull call, see if it gets back up to 12 resistance level, back up here, or somewhere close, maybe that 1157, that 200 day, because they had a fantastic earnings and went all the way out for a year, or not a year, excuse me, out to January, about 6 months. Reasoning was going out a little further where we had time to see if we got any bit of a political bounce from politicians talking about gun control, and AOBC making a little money on that idea with people getting scared and going feel like they need to go buy a bunch of guns. So since then, it's come back. Kind of silly, but that is what it is. Still hanging around $9. So if you wanted to start this one, it's still good. Nothing really has changed other than, just some of the same that we've talked about with the economic and political Trump tweeting and China trade deal and Fed rate cuts, stuff like that. So there is no reason why, if you aren't looking to go ahead and start a new one, why this wouldn't be a good idea. But if you'd already done this one, on the other hand, is also a good idea to go ahead and double down. It was only like $235, if I remember right, all in all, net to net, and go in and pay in another 180 or so to add 3 more contracts. So that's that one. Are there any questions? I kind of flew through it, but I think it's pretty straightforward. Just to go look at it real quick, AOBC, January 20, all the way down here. And this is the one. 10 long against a 1250 short. And you probably get filled around 77 cents. And lower your cost basis by another 19 or so. So again, that knocked us down from AOBC. Added 3 more contracts. Dollar cost average the bull call position we had on. And that was January 2020, month 10 or long call, 10, I guess I should say 10 strike. Against a 1250 short. And actually, you could argue going down a 12 even if you're looking to start a position like this. Take a quick look. I guess there's not a 12 even. So that's why we went 1250. Makes sense. All right, forget I said that. 1250 short call for about 75-cent cost basis. For a total of 3 contracts. That's what we did. We added 3 more to lower the cost basis down to about 68 cents. Not a ton, but it does help with such a small, cheaper cost basis like that. That makes sense. And that's that one. Not going through all of the details of the math because, we did that and it's pretty simple. And if you want to do that, those are the numbers you're going to end up with if you get filled around the same prices. Chances are tomorrow you might even get a better price, but it has been pretty smack dab right on $9 for last week. So, any questions on that one? Alrighty. Looks like that one's pretty straightforward. Let me go to, I just want to see what we had for yesterday, July 12th expiration, 197.50, 200 bulk call for limit debit of 175. So let's just take a look. He had mentioned he thought he had gotten filled, but maybe, again, it may have been in a different account or for something else. So let's see, August 12th. There isn't an August 12th, which means maybe Kevin is smoking. July 12th, sorry. He's not. He's good. Wow. 3 days. That's what we're looking to. I lied. He is smoking. 3 days? 3 days. That's right, because he's looking to see it expire worthless. $197.50 and 200. Let's just do a little math. Not that math. We need $97.50 for full call. So 230 minus 425. For 195. That's much higher than he was looking at. So let's look at an Apple chart. It had gone up today, which is why it's so much higher. Bouncing right on 200, it looks like. All right, so I'm just going to say, if you don't get filled at something under $1.75, then maybe this was a missed opportunity. So we're just looking for deep in the money, quick 3 days to see if it expires worthless, or I think 75 cents is what he said. Yes, max return, 75 cents. So let me just take a quick look. I want to see what, while I'm rambling on here about Apple. So the extended hours trading is saying it is down a little bit. 287. $200.87. So there's a chance, if you were to do it tomorrow, you could get filled if you set a limit of something under $1.75. Man, darn E-Trade, I wish they'd actually show the prices after hours so I could show you the snapshot analysis, but I don't. Anyways, you want to be setting a limit of this bad boy of 175, or even see if you can't get filled closer to 160, and see what the day gives you. So let me go ahead and throw that one in. July 12th for 3 days. $197.50. So hopefully I just misunderstood Kevin as we talked over the phone about what he had seen get filled for him today. But I'm pretty sure he said that he got filled at around 160 for this today, but it doesn't look like it. So again, chalk that up as Kevin smoking something. And I hope you guys will make fun of him and give him all sorts of crap for it on Thursday. So limit order of 175 or less. This is a bull call. All right. Any questions on that one? kind of already went over that in detail. Uh, Out of curiosity, did anyone get filled on a Apple bull call that he suggested yesterday? Anybody? Well, okay then. All right. Not seeing any questions or comments coming in. So I'm going to go into another thought. We do have Disney leap long calls. But again, with the thought process of not knowing exactly where you guys are at and new folks coming in and, the idea here is to be putting out new trades, showing people, recommending, new trades to place each week, and kind of showing you how we've adjusted the ones we've already been doing. So again, it all depends on what your portfolio is doing and where you're at. If you're kind of stacked to the rafters already with money being put to work, then obviously don't worry about it. But if you're looking to do something new, I was looking at, again, a Disney full call at a shorter one out to fourth week of July. That's where I was going to. July 26th. $35 from 40. There we go. Hey, what do you know? It's showing our prices. Okay, so let me just look on one contract each, and that way you can decide how much you're going to be putting at risk. So a total of $110 of max profit. And we're just looking for it. This is obviously similar to the one we looked at for Apple. Shorter time frame, but we're really just looking for it to stay above our price. So let's check out a chart for Disney. So you can kind of see pretty clearly what I'm seeing. A pretty clear bounce here at $140. This is $140. You can see here it was kind of more a resistance. And since the first of the month, it is broken above and bounced right on 140 today. And I want to see it continue to hold that support and go up. So this is what I'm suggesting. A July 26, 135, 140. 140 pays for like half of it, almost. And the shorts pay for half of it, rather. Close to. And we just want to see it stay above 140. So another reason, while it's on my mind, I just like how Disney has weathered some of the current market issues. Did get quite a good bounce over here on the beginning of June, but took us above this resistance level shorter term here at 135, and this is the one we're kind of breaking now. So the best way to say that is I like how Disney has weathered the current market, market worries. The trade is 130. July 26th. Full call. 135. 140. And that was for extended hours. Trading is saying Disney is pretty much the same. Markets are flat. So we're looking at about 390 midpoint, or better if you can find it. $3.90. Any questions on that one? Keeve, this is a dumb idea. Keeve, I like it. Any thoughts at all? All right. Ooh, I did get one. Thank you. All right. I wanted to link this article. Kind of goes over what Kevin was talking about, and he and I have discussed. It just kind of seems like they've gotten that downgrade, if you remember. Fell from 205 and kind of bottomed out around 198.50-ish, at least in the last few days, and then bounced right on 200 and looked great today. But it had gotten downgraded because of the idea of worsening iPhone sales and a bunch of stuff like that, which just kind of seemed more of the old complaint that analysts have been throwing out there for even years. All about iPhone sales, and yes, that was the big part of it, but we also have services that are coming in and replacing or adding to a lot of what they're not a lot of is really kind of taking the center frame on the future of Apple earnings and where we really see Apple taking off and continuing to make money. Their services and their news, subscriptions, and all of the new stuff they put out. And it just seemed like that it was Rosenblatt. Cut the name, cut Apple because of iPhone. They think that they're going to have a rough time keeping up their iPhone sale numbers. Just kind of think it's old news, old way of looking at things, and Apple themselves is kind of looking for completely different things than some analysts have been looking at for years. So it's kind of silly. Seems like same old stuff. Check this article out and kind of goes over a couple points on why that's silly. And that's pretty much it for me today. I did get a question. We found an optimum number of contracts for trading. I know that position sizing depends on portfolio size, etc., but please comment what you have found to be ideal number of contracts. That is a kind of a floor for option trading, 5, 10, 15, 20. My answer can be saved for another class. No worries. It's pretty simple answer, and I don't think you'll like it, Ida. It depends. So just look at what we have here. We've got AOBC that cost like $200, and we had 3 contracts, right? And that was kind of what fit, yes, our portfolio size here, but it was just something, one little more thing that kind of diversifies us a little bit more and gets us into filling out this portfolio, maybe on the side of too much, but it was cheap and there was plenty of time. So 3 contracts for just a couple of hundred where we're not putting the portfolio into margin seemed to work great. And that was the thinking behind only those 3 at the time. And that obviously gives us gives us the ability to dollar cost average, which is what we're talking about today. So maybe that's a couple hundred more, but that's kind of what the thought process was. So I guess the principle I would say is, so let me write this out because I think it's a good thing to talk about real quick. Is there a rule of thumb, I guess? Number of contracts to buy. And answer is so then you look also at the one I suggested was Disney at $390. So one of those is going to cost you $390. So again, yeah, it does depend on what funds you have available and whether or not you already have a Disney, the Disney one we have. If you already have a long Disney call, leap long call, then this isn't even something to consider. But for someone new coming along that is looking to do something or just add to several other positions they already have, it all depends on what positions you have, meaning obviously we want to diversify a bit. Rather than just sticking with one. Also depends on the ability, I should say, the funds you have to be able to dollar cost average. So if you're color trading, we dollar cost average by buying puts, and if it falls, then we're able to buy more shares, right? But if you're doing spread trades or leap long calls, kind of like the bulk of what this account is doing, you're looking at leaving yourself enough space for dollar cost averaging. And that goes for several positions. So just take a look at this. We have not a lot of cash buying power. So we're not in a great position with this one to be able to be dollar cost averaging a lot of positions now. But we also have longer term positions that are very profitable and look great. So in a pinch, obviously you could sell some profitable positions to go in and fix these crappy Baidu positions. Just so you can get positions that aren't working time to work. So to voice that out on paper, color trading, it means our puts allow us to buy more shares if prices fall. But for an account like this, we're leaving room. Let me put this towards the center. Leaving room to dollar cost average leap long calls and spread trades. So it's 100% depends on what you've already got and how much cash you've got to take care of those trades that you already have going. Obviously, we have dollar cost averaged a few of these as well, which is why we kind of have more money to work and don't have as much cash. But leaving yourself room enough to dollar cost average any new positions you're looking to put on. If you're going a leap long call on, say, Facebook or whatever, Baidu, and you're just starting this one, obviously you want to leave the room to where if Baidu falls more, you're going to be able to buy another contract or what have you. That's kind of the thinking along those lines. Or, like our case, we have profitable positions that we can close. But again, for our case, we've already dollar cost averaged some positions and we're just letting them work, and we're holding on to good positions like our Leap, Facebook, and Visa so that, we can see as much upside as possible for those ones out to the future. So does that kind of help answer your question, Ida? It was a good question, by the way. But number of contracts, it really just depends on how much cash you have, what profitable positions you have, making sure you have some diversification and the ability to give yourself the time and lower your cost basis by dollar cost averaging the leap long calls in the future. So no, I guess the answer is there's not an optimum. I have to dig deeper concept of dollar cost averaging. Dollar cost averaging is simply lowering your cost basis. You are buying the same position you already have on to lower your overall cost basis. Cost basis is the price averaged over all of your shares. So that you need it to come up less to be profitable. That's all we're thinking about with dollar cost averaging, is your overall cost average is lower by adding the same position. For bull calls, it's adding another contract to lower your cost basis. And it just goes down to the simple math. Looking at support levels, looking at, Apple fall all the way down to 175, and say you put on a bull call up here thinking at 200 it's going to continue to go back up to 230, and it doesn't. It falls all the way down to 190 and breaks through the 200 day and keeps falling. Maybe you put on another position to dollar cost average down here at 190, 185, and then it keeps falling, and you're at another support level, and you have the cash available to continue to add to that position. But It's just about working the numbers and doing the math. So I hope that wasn't overcomplicating the question, or my answer wasn't overcomplicating it, but I hope that helps a little bit. Guys, are there any other questions? And I would recommend going back to when we first did the Baidu one. Go online to Hurley Investments and check out the one where we first did this 180 September calls, and it was a full call spread at first, and we cashed our short call position in to be able to triple up on contracts on our long call positions. I think that's a good one to go through. I think it was beginning of June. Look on the June videos, and yeah, it might have been mid-May because it was after it fell, and then we had closed all of our short call positions to dollar cost average and allowed us to triple up on our 180 calls to lower our cost basis. And I went through all of the numbers on that, so go check that one out. Guys, if there's no other questions, I hope that was helpful today. And I'll be joining you Thursday. Kevin will be presenting, but I'll be there as well to follow up with everything and see how you guys make fun of him for the whole Apple position. Great. Glad that was helpful, Ida. Guys, thanks so much, and we will see you Thursday. Take care.